Good afternoon. Welcome to this NextWealth Insights webinar. My name is Heather Hopkins and I'm joined by my colleague Julie Best.
Good afternoon. I'm Julie Best. I'm Qualitative Researcher at NextWealth.
Great. Really pleased you're able to join us today. Let me go into the slides to tell you what we're going to talk about today. So NextWealth with the PFS do a benchmarking report. It's our second year doing it. It's a free report available to anyone for download from our website. I've got the URL here, but we'll redirect you at the end of the webinar to that if you don't have the full report. How we do this report, it's a survey of PFS members with 365 respondents this year. And it was conducted in the first 2 weeks of August. And we're able to compare what happens year on year because we have that annual date for doing that research. Why we do it, there's really two main reasons why we're doing this. First, we think it's important. We want to provide insights and ideas to financial advice businesses and people working in those businesses about what their peers and colleagues are doing in other businesses to help them meet new challenges and opportunities. It's also an important part of our business. It supports our research and insight into the changes happening in the financial advice profession. The particular areas of interest for us are size, shape, and composition, changes to business model, investment proposition, and tech setup. As we repeat it every year, if there are things you think that we should be asking about in the survey, please let us know. There's a few things we ask each year, but there's always a couple of areas of deep dive focus. So if there's things you think we should be looking at, do let us know. My email's on the last slide, or you can just drop either of us a line. So let's get into the results. The first section is around the profile of financial planners and firms, and I want to start with qualifications. So we asked respondents to the survey whether they were working for a firm that had achieved chartered status or was working towards chartered status. And we were really pleased that this year we found that 32% of respondents are working for firms in a firm that's achieved chartered status, which is a really high level of qualification. So fantastic level of achievement for those firms. And 48%, so nearly half of firms have either achieved it or are working towards chartered status. And that's up from 44% last year. So seeing that continued move towards professionalism, high standards within the financial planning community and financial advice businesses. We also asked individuals about their own level of qualification. So of the respondents, 16% had level 7 qualification, which could be the CISI diploma in advanced financial planning, for example. 45% had a level 6, which could be the CII diploma, advanced diploma in financial planning. And 38% had a level 4, which could either be the CII diploma in financial planning or the CISI certificate in paraplanning or others. So again, really high level of standard across the respondents, and something we think that the community should be really, really proud of. We looked at the profile of financial advice firms. And it's really hard to define an average, right? Because, I mean, as everybody listening will know, the financial advice market is dominated by SMEs, a large number of firms with 5 or fewer financial advisors, about 80% of firms with fewer than 5 financial advisors within it, and a small number of very large businesses. So it makes defining averages really difficult. So we tend to report medians, but we did look across the results across different types of firms and sizes of firms, and to find this average financial advice firm has 7 employees. 3 of them are client-facing financial advisors. 1, so that orange represents the support or ops person. Yellow is client service, and red is other. That could be compliance, or in this case, paraplanning. But as I mentioned, there's a lot of difference across different size of firm. So let's look at that broken down by number of employees. We've left off sole traders for obvious reasons, but for firms with 2 to 5 employees on the far left of your screen, about half of employees are financial planners, and then over to the far right is firms with 50 or more employees, where just over a quarter of employees are financial planners or financial advisors. A few things stood out to us in this. So if you look at that yellow bar, that's client service employees. So about a quarter of employees across all different sizes of firms by employees are in client service roles. That's incredibly consistent across those different sizes of firms. The other thing that stood out to us was the support and ops personnel. So from six employees and up, really consistent at 18–19% of employees. Where things look a bit different, you might look at the compliance staff with those 11 to 20 employees with more compliance staff. What we think is happening there is small firms tend to rely heavily on outsourced compliance, and so tend to have fewer employees within the firm. And then large firms will have a mix of outsourced support and in-house support, and so those wouldn't be employees within the firm. The other one that's really obvious that stands out to everyone, I'm sure, is that red bar, other staff. So that's head office staff. And so those larger firms, 50 or more advisors, tend to have much more people working in management roles, overseeing the business. And you see that growing from 20 to 50 employees up to 15% of staff for 50 or more firms with 50 or more employees. Now, the FCA publish from the RMAR data every year some data on profitability of firms by number of advisors. And you might have seen those results, and they show that firms with between about 5 and 20 financial advisors tend to be the most profitable per advisor, and the largest firm tend to be the least profitable. And there's various reasons for that, but that overhead cost of those people in management positions certainly be contributing to that. So let's move on to the next slide. Some really interesting data on the changing face of advice. So obviously diversity and gender diversity, but other types of diversity is in the news a lot. So we wanted to look at whether there was any difference by age group of the profile of financial advisors and financial planners. So what we found was pretty clear difference. So among respondents over 55, 1 in 10 are female, and among the financial advisors below the age of 45, 3 out of 10 are female. So a real difference, and we should see that coming through the industry as those younger financial planners, of course, get into those older age categories. So let's move on now to the impact of COVID-19. We're going to look at two things in this presentation: gross revenue and new clients. There's a couple of other things covered in the report, recruitment, and a few other bits, but we're just going to focus on these two in the presentation. So we asked advisors what they estimated the impact to be on gross revenue for this financial year as a result of COVID-19. And what you can see is that most said that there was a negative impact of the COVID-19 on their anticipated gross revenue for the year. So that's in that blue box there. So 75% as a total expect or estimate a negative impact of COVID-19 on gross revenues. That was worst for the smaller firms with 2 to 5 employees. 83% of financial planners and financial advisors said that it was a negative impact on gross revenue from those smaller businesses. But if you look at the results, you can see that there's a huge concentration to the -1% to -20% impact on revenue. So 30% are saying only a 1 to 10 hit on revenue. And in a small business that can be significant, but those reporting a fifth or more is much smaller. There's also a few firms that are showing a positive impact of COVID on revenue, which is really interesting. Now, we also asked advisors about the impact on new client inquiries and new business, and we think that the impact of gross revenue is a result of a slowdown in new business rather than existing customers leaving the firm. And also remember, the survey was done in the first 2 weeks of August, so it wasn't a result of the market declines at the beginning of lockdown in late March and April. So it was, I think it was 44% of advisors, so nearly half, said that they'd seen a negative impact on new business inquiries, but that had picked up since the harshest measures of lockdown had been introduced. So new business seems to be improving. We also asked about the number of clients that advisors are working with and whether that changes year on year. And that's on this slide, report on this slide. So we asked, are you working with about the same number of clients as last year, more than last year, or fewer? So again, to that point that it's not existing clients leaving firms, 51% of advisors say that they have about the same number of clients as last year, and 45% actually say that they have an increase in number of clients over last year. Now, this is over a year. We're only, 7-8 months into this coronavirus crisis, right? So it's more than just the COVID that we're talking about here. But we think that this shows that the health of the financial advice businesses should be strong through this crisis. As clients are sticking with advisors, it's really a slowdown in new business. But when we compared these results year on year, it just pointing to that 45% that say they have more clients than last year. That's a lower proportion than last year, when it was, I can't see this behind my video, sorry, 62% last year were saying that they were dealing with more clients than last year. So business is up, but optimism potentially being hampered a bit. Now, keep in mind, for all of this data, it's based on what people are saying in a survey. It might not be actually what's happening in the business. And as a market researcher, I always have to remind myself that people do their best to give the right answers in these things, but sometimes they don't have the numbers exactly to hand. So some of it's based on perception, so their feeling of how the business is doing rather than actual concrete numbers. So it's just important to keep that in mind. So let's move to, sorry, let me move my mouse, to financial planning process. So we wanted to assess the time spent across the financial planning process, and I'll chuck through that and then pass over to Julie, who will talk about workflows, and then the next section on tech. So we divided the financial planning process into 7 steps and asked advisors to estimate the time spent on those various steps. And you can see the average broken down here. So establishing client needs and goals, about 3 hours spent on that in the first year of a new client relationship. Gathering information, about 4 hours, again, in that first year of a new client relationship. Analyzing information, 4 hours. Developing a plan, about 3 hours. Presenting back to the client, 2 hours. Implementing the plan, 3 hours, and then monitoring and reviewing, 4 hours, which comes to a total of, on average, 22.6 hours spent in that first year of a new client relationship. So a couple of things to look at here is, this isn't just the advisor's time, this is across the whole firm. Again, it's an estimate, but if we look at the time spent with face-to-face client activities, establishing the plan, presenting the plan, and then some of monitoring will be client-facing. That makes up only a small share of that time spent across the financial advice business. When we did a survey for Fidelity earlier this year, on average, advisors estimated they were spending about a quarter of their time with clients, and they were spending more time on admin and compliance combined than they were with clients. So we hope that this will help just put a focus on the time spent across those activities, making sure that the right people are doing those activities, so that financial planners and financial advisors are spending their time with clients and trying to shrink the time spent on other activities. Now, we looked across the data to see if there was anything that we could see that showed, these firms are spending less time on activities, more time with clients. So there's anything we could see there. And there was a couple of interesting things that came out of that analysis. The first was on age. So older planners tend to spend more time on client-facing activities, establishing needs and goals and presenting that back to the client as compared with younger clients. And it was about an hour difference between those two different groups. So a pretty significant difference. Younger financial advisors and planners tend to be spending more time gathering information, analyzing information, and then monitoring that on an ongoing basis. So, that might be a difference in the style and the approach. It might be a difference in the type of technology and systems being used, but it also could be just a different focus for those financial planners. So thinking about where you're adding value and making sure it's, financial advisors and planners are spending time with clients. The other really interesting thing we found was that use of tech seemed to impact time spent with clients. But it wasn't even. It wasn't just if you're using tech in the business that you'll see savings in time across these different activities. It was very specific to the type of tech that you were using. So we found a difference with advisors using Intelligent Office, Cash Calc, and IntelliFlow's PFP. Now, we don't have enough responses to look at other client portals, so we don't know if other client portals would show that same result. But we saw, particularly with CashCalc and IntelliFlow's client portal PFP, that advisors are spending less time on every single one of those activities, those 7 activities. Now, I'm not arguing that if you use CashCalc, you're going to spend less time analyzing information. It probably has a lot to do with the way that those firms are structuring the business, the way that they're operating, and how they're running the business, not the fact that they've just used CashCalc. So I'm not saying if you use CashCalc, you're suddenly going to be spending, 2 or 3 hours less time analyzing information and gathering information. But it does suggest that firms that are integrating tech into the business, making really good use of that, can see savings across these different activities. I'm now going to compare to the US. So Michael Kitchis, if anybody hasn't heard of him, definitely recommend subscribing to his newsletter. He's an American financial planner, but also does a lot of research and commentary around the financial advice market in the US, and has some really, really interesting stuff. He does a podcast with Carl Richards, who's now based in the UK. And the idea to break down the financial planning process into these 7 steps actually came from a survey that he did. And we replicated that in the UK to see how it compared. And it's really helpful to have this comparison because what you can see here is in the UK, financial advisors and financial planners are spending less time on average than American planners. And we sometimes think that American planners might have better tech, they might be running more efficient businesses, they have a different regulatory structure and framework, but actually it doesn't seem to be coming through in time savings. But back to my earlier point, this is perception, not reality. So there may be differences as a result of that, but an 11-hour difference on average across the two, to me, suggests it's more than just a cultural difference, and there might actually be some cost save or time savings there. I'm now going to pass to Julie, who's going to talk about workflow.
Thanks, Heather. Also, just to say, if anyone has any questions on anything that Heather's covered so far, do feel free to drop that into the chat function at the bottom of the screen. We will have time at the end of the presentation to answer your questions. In this section, we're looking at the mechanics of delivering the financial planning proposition in terms of business processes and workflow mapping. And by that, we mean analysing what's involved in delivering the proposition, what are the tasks and workflows, and who has responsibility. I think it's more interesting than it sounds. We tend to hold on to what's worked before, what we've always done, because we got the job done and it was successful, even if things have evolved such that that isn't really the most efficient way of working now. We looked at this in the survey for 3 reasons. Workloads are increasing. As Heather mentioned, there's more compliance, there are more admin tasks to squeeze into the day. Adding resource, whether that's tech or hiring people, is expensive, and pressure on margins is pressure to be as efficient as possible. Lack of process mapping and documentation was named as one of the top 3 challenges to productivity faced by financial services firms. And that's according to some research by Cerulli that was conducted last year. If you want to improve anything, productivity, efficiency, add new resource, add new tech, or if you want to make dealing with change less stressful, say a new regulatory requirement that means adding to the workload, you need to know what you're working with, where you can improve things, where you can work in something new, and that's much easier if it's mapped out. So to look at the results from the survey, Heather, could you just flick onto the next slide? Thanks. We identified 5 steps to conduct a business process review. 3/4 of firms have done at least one of the steps, so that's good news. Larger firms are more likely to have done more of the steps for obvious reasons, more scale to manage and so on. 61% of firms, thank you, 61% of firms have done the first step of the process, so listing out all the tasks, contacts, events that should occur along the journey of creating and delivering a financial plan. So that might be, in practice, a client lead comes in, it gets logged here, that prompts this activity, it prompts a planner to make an introductory call, that gets some documentation starting to be prepared, and then most firms have identified the team member responsible for each step, but then the numbers kind of trail away a little bit. So 37% have visualized that process, so kind of creating a diagram or a map of the workflow. and only 30% have analysed that workflow to look for bottlenecks or areas that could be improved, and then gone on to set out an action plan for improvement. So we think this is an area that more firms could benefit from spending some time on. Advisor tech is the next section we look at. Tech is another reason to map business processes for two reasons. A, to understand the workflow and where tech can be applied to make bits of it faster, better, more effective. And secondly, to customize any new technology purchases wherever possible to align with the firm's workflow. So building workflows into back office systems and so forth. Tech is a significant spend for firms. So we asked about annual tech spend in the survey. And as you can see, 58% of sole traders are spending up to £5,000 a year, but a fifth of sole traders are spending more than £10,000 a year. That's a fairly significant spend, and it's a little bit higher than last year. At the largest firms, so that's firms in our category with more than 50 employees, a third are spending over £100,000 a year. So it's a significant area of business spend. We're publishing a detailed report on advisor tech next month, where we look at a particularly hot topic at the moment, so document submission, use of e-signatures, what tech is most used by planning firms, and advisor reviews of tech solutions. So you can email us if you'd like a copy of that when it's out next month. You'll find Heather's address on the last slide of this presentation, or our details are on the website.
Great, thanks, Julie. So just to wrap up what we've covered, and then we can go to questions. So we've had a couple come through, but please do put those either in the chat or in the Q&A. So we're really pleased to see the high level of qualification. I think that's something that the financial advice and financial planning community should feel a lot of pride in. Fantastic that nearly half have either achieved or are working towards chartered status. The impact of COVID, as we've seen a negative impact on gross revenue for financial advice businesses, but client numbers are holding steady and new inquiries are starting to pick up. The proportion of time spent on client-facing activity is something we think that firms should be looking at and making sure that, as Julie talked about in that mapping workflows, making sure the right people are working on different activities so that we can move the dial on having advisors spending, a quarter of their time spent with clients and more time on admin and ops, compliance, and identify those bottlenecks to try and build efficiency within the business to scale. So with that, we can go to questions. So my mouse was in front of the screen because the Q&A box popped up. I was trying to figure out how to close it, but we had a question come through about the average age of a financial advisor. So we can start with that one. So the average age of financial advisor in the research we did last year, we calculated this was between 45, I'll just grab my paper, it's between 45 and 55. And the average, when we looked at the medians, was 49. And we checked that with the PFS and they confirmed that across their financial advice, the financial advisor members, not across their entire membership base, but among their financial advisors, that they had the exact same figure, the 49. So sometimes people think that the average age of an advisor is in the mid 50s, but actually it's 49. One of the things that we looked at in the research, Julie, was e-signatures and digital signatures, and it's something that we've done a little bit of work on, or quite a bit of work on, over the past year, and we found that only half of advisors are making use of e-signatures or digital signatures in some form. And I was wondering if you could talk, because I know you've been speaking with financial advisors and planners about this. Can you talk a little bit about what you're hearing in the market?
Yeah, absolutely. So as you said, we were a little bit surprised to see at this point in early August, 47% of firms aren't using e-signatures. In conversation, I think that number is growing all the time. There are obviously more providers who are accepting digital signatures. We've spoken to firms who perhaps had it on the roadmap, had it on the sort of development plan at some point, and are kind of bringing that through. And firms have talked about within their own businesses and in the wider industry, seeing, somebody said 10 years worth of change in 3 months in terms of the pace of kind of implementing these new new working patterns, new technologies, and so on. I think there is some mixed sentiment about using e-signatures and about getting clients to sign documents digitally. We have spoken to firms, particularly where they might have a slightly older client bank, and also for other clients, the kind of, and the advisors and the planners feel that having a client physically sign that document is a level of commitment that's difficult to replace electronically, but it's something that's certainly becoming more prevalent. And I think there's also a bit of an issue in the industry at the moment about the confusion between the two types of signatures. So you have electronic signatures and you have digital signatures. And we've heard reports of some planners finding some confusion at the provider end, where a provider will say, yes, we accept digital signatures. And then they'll be asking about checking whether it matches a signature that they've got on file. And the advisors are kind of going, but it doesn't matter if it matches. It's a different type of verification. But yeah, I do think it's certainly going to be something that's growing.
Yeah, it's fascinating because there's been quite a bit of pressure, I think, on providers to step up. And we're really pleased to see in due diligence on platforms and some of the other advisor tech providers, advisors including a question about how easy it is to facilitate business. And it does seem to be a shift happening, which is great to see. But I was actually surprised that, given all the noise about it, that actually still half of advisors aren't using them, which is fascinating. We have a question through from Fiona Tade. Oh, sorry, maybe I shouldn't have mentioned your name. Sorry. I should have checked that first. Anyway, she was asking about if we've seen any evidence of firms revisiting their fee structures towards fixed fees, especially in view of contingent charging ban. And I'll follow up with you, Fiona, because we did some work with Aegon on retirement advice, specifically in DB transfers earlier this year. And I can share some of the stuff we did in that. I mean, when we've asked about this, I think there's a few things that firms will have multiple options for charging, but most tend to still use a basis points charge. Even though they'll say that they offer multiple options, but then when you ask about how it's used across the client base, the majority are still on basis points. I haven't seen any shift in that. And I looked at the FCA data that came out and the RMAR data, and they show the income from different charging models. And I don't remember seeing anything different in that. Julie, I don't know if it's come up in any conversations you've had.
It hasn't recently been something we've touched on. No.
It's such an interesting question, because I think part of the issue is if you want to have the fees facilitated by the platform, a lot of times they can't support anything other than basis points. A lot of platforms can't support anything but basis points charges, and it doesn't mean that it shouldn't be done, but it can be one of the barriers. We also don't see in our client work much demand. We've done a couple of focus groups recently, and in all of the research I've read with consumers, I haven't seen much demand for a change in charging model, which is where that would be really driven from.
Heather, I was just going to mention, we've got a couple of our sort of upcoming reports mentioned on the holding screen there. And the top one of those is ESG tracking, which is sort of timely, given that's what we're publishing today. So that's obviously another big trend in the industry, the growth of ESG. Did you want to just touch on any of the kind of headline stats from this report?
Yeah, sure. And we included a bit on ESG in the Financial Advice Business Benchmarking report. So we've seen steady growth in assets. So about 12% of client assets in ESG, ethical, impact, or sustainable. I think I've caught all of the headings there. And the reason we use that large bucket approach is because we wanted to make sure we caught as much as possible to understand the assets, where it's coming in conversation, whether advisors are using that much wider definition, not just ESG specific funds. So 12% of client assets, up from 7% last year. and 89% of advisors are using these products or solutions in their business. So wide adoption. But what we found is that most of that comes under the ethical heading. So ESG, we think, is about managing risk, investment risk, and that could be either usually it talks about the risk of a negative impact on our portfolio as a result of climate change or social issues, or some a poorly governed company you would expect would do worse financially in the long run. So we think that ESG is really about risk mitigation, whereas ethical investing is about people's values and how they want their money to be invested. And we think that that's niche, that ESG will be mainstream. But most of what's happening now falls under the ethical heading, not that wider ESG heading. But we're happy to share the report. It'll be up on our website later today. So again, a free download, kindly supported by a group of asset managers and platform and a data provider, which is great. Perfect. I don't think we have any other questions coming through, so we may as well wrap up there. Oh, sorry, we've had one more. Is there any data on face-to-face client meetings being replaced by screen-to-screen? So yeah, but the really interesting thing is there's still a lot of advisors not using video in their meetings. So again, that research I referenced earlier that we did for Fidelity, we asked about use of video in the business, and so whether they used video, phone, or face-to-face meetings primarily with clients before coronavirus, and then what they had transitioned to during coronavirus, and what they expect after the strictest lockdown measures are lifted. And only about half of the advisors that were doing face-to-face moved to video, about half of those moved to phone meetings. So again, huge, lots of talk about adoption of video, and there has been a massive increase, but half of advisors that were doing face-to-face meetings moved predominantly to phone meetings, and that was done in May. So again, it wasn't right at the start of lockdown. There was a bit of time given for that shift. And when we asked people about what they expected to happen afterwards, the advisors who had shifted to video meetings were much more likely to say that they were going to continue with that mode of business. It wouldn't be the exclusive way that they would do things, but they were much more likely to say that post-COVID they would do mainly video meetings. Whereas the advisors who said that they had gone to phone during the strictest measures of lockdown, they expect to go back to face-to-face, which I think is really interesting, and is a reminder that it's good to try these things. It's not going to be for everyone. It's not going to be for every client. But we have heard some fantastic results, and Samantha, you might be able to share some of those from your clients in a separate conversation. But advisors saying that they helped client refinance their homes, that they could do renovation, and they're able to get a tour on the video of the home that they helped to refinance. They're able to meet with the whole family rather than just the client. Whereas if you have to have people come to your office, it's much harder to meet with the children or the spouse or whoever else, to include them in that conversation. And by meeting virtually, that can change. So I can share. I'll send you that. I'll send you that report after the call. And if anyone else would like a copy, just drop me an email and I can send that to you. So anyway, so we'll wrap up. I've been trying to figure out how to close this Q&A bar and I can't figure it out. So I can move it to the side. So just to wrap up, coming up next from us, we have an ESG tracking report coming out today. Our advisor tech stack research that we're updating is coming out in November. Julie already mentioned that. If you'd like a copy, just drop me an email or pop over to our website in November. It's a paid for report, but we will do a webinar with some of the findings. And our NPS proposition report that looks at charging models, use of ESG, agent as client, VAT, all of that good stuff will be coming out in November. And save the date for the Schroders UK Platform Awards, 15th of December. We're going to do it virtually this year. And NextWealth Live, 23rd of March. Thanks very much for joining. And yeah, drop me an email with any questions. Thanks.